Precious metals research firm CPM Group has updated its gold forecast for 2017 post the Trump election. Joining me today in studio is CPM Group's Managing Director, Jeff Christian. Jeff, good to have you back on the show.
It's good to be here.
So here we are about to finish 2016, and looks like gold's going up against a lot next year. We have, rising dollar now, rising interest rates, and a very strong stock market. The Dow closing in on 20,000 here as we speak. How does gold go up against all this?
Well, we think that gold will struggle in 2017. Longer term, I think a lot of the factors that we're looking at beyond 2017 are positive for gold. But I think 2017 is going to be a difficult year because, as you said, Trump will cut taxes. That money will go into the stock market. The stock market will move to new highs through the course of 2017. As the stock market moves up, that will pull the dollar up. I think the interest rate issue is a little bit less important there, but it's obviously, if you look at the prices today, the 15th of December when we're recording this, obviously it has an effect. So I think that gold will struggle, at least in the first half of 2017, because it just won't be able to compete with the dollar in the stock market.
And you've since updated your forecast.
Well, we're constantly updating it, and we publish it for our clients once a month. And post-election, we have lowered our price projections for 2017. So we were probably around 1320 prior to the election as an average price for 2017, and now we're about 1300 for 2017. And then we've increased our longer-term price projections. So we had the prices moving to record levels over the next 5-6 years. We have them moving to record levels a little bit faster and sooner than we had before.
So what is the key driver behind that?
The key driver is that, what you're going to have is a sugar high in 2017 for the stock market and the dollar. And it's not sustainable. It's not going to be reflected in better unemployment figures. The deficit will probably explode because of the tax cut, regardless of any infrastructure, which we're very pessimistic that you'll see increased spending. But the tax cut will explode the deficit once more. And as you go forward, you're going to see that the increased deficit, the increased debt, is going to put an increased burden on interest rates. And it's not that the Fed will be pushing interest rates up, it's going to be that investors are going to be pulling interest rates up. If you're going to run that kind of deficit and that kind of irresponsible government, at some point the people who are lending you the money, the pushers if you will, are going to demand a higher price per unit. And so that, on a long-term basis, you're going to see. You've got a lot of structural problems around the world, politically, economically, and in the financial markets. They will come home to roost. They probably won't come home to roost in 2017, but they will come home to roost.
Investment demand was such a key factor in 2016 when talking gold. How do you see that playing out in 2017?
Yeah, well, investment demand, which had been running 30-40 million ounces a year on a net bullion basis prior to 2014, it fell to about 13.5 million ounces in 2015. It was probably around 20 million ounces when the final figures are in for 2016, and we have it rising another 10-12% to about 22.5 million ounces next year. So we think that investors will continue to buy, and in fact, the relatively stable prices will probably allow investors to buy more gold as they look at the longer-term implications of everything that's going on in the world, and they say, yes, we do want to buy gold.
Shifting gears here, silver. How do you see this metal?
We're more concerned about silver. Investment demand's running around 100 million ounces, and quite frankly, investment demand probably needs to be closer to 150 million ounces to really see the silver price rise. You have a lot of mine production coming in. Scrap is still big. You're seeing some weakness in fabrication demand. It really comes down to investment demand. And our expectation is that investors are going to be hesitant to buy 150 million ounces of silver next year. They might buy 100 million ounces. And that's probably going to keep the price. We have an average price for 2017 of about $18. And we think the price will probably trade between, say, 15 and 21 over the course of the year.
The U.S. dollar has really been a thorn in the side of the metals this year. Do you see the U.S. dollar rally continuing next year?
Yes. We had been thinking that the dollar would trade sideways to higher, modestly higher, But I think with the election of Trump and the likelihood of big tax cuts, which, as I said, we think will almost exclusively go into the stock market as opposed to real investments, we think that the dollar will probably be stronger in 2017 than we had been thinking, and that's going to be a negative for gold.
Jeff, Christian, thank you so much for your outlook. Happy holidays to you.
Happy
Thanks for joining
holidays.
us. And thanks for watching Kitco's Gold Outlook. We'll have more for you in the coming weeks, so be sure to stay tuned.